Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing that is all about setting up new financial instruments, and let me tell you, it reads like a company planning for a long game, maybe even to make sure its popcorn is perfectly popped for future movie nights. We're looking at Citigroup Inc., and this particular report, a Form 8K, is like a special bulletin announcing something important has happened, and in this case, the big news dropped on the 2nd of February 2026. Although the report itself is dated the 3rd of February, it's all about setting up a new class of preferred stock. And this isn't just a minor tweak, it is a strategic move. Think of it as creating a new type of VIP seeding to attract different kinds of investors. So, what exactly did they do? Citigroup Inc. filed a document called a Certificate of Designations. This might sound a bit fancy and complicated, but essentially, it's like drawing up the official blueprints for a new type of stock. They've established a new series of preferred stock, and they're calling it the 6.250% non-cumulative preferred stock. Series 2 breaking that down. Preferred stock means these shares have a different set of rights compared to the regular common stock that most people own. Non-cumulative means if Citigroup misses a dividend payment for this stock, they don't have to make it up later on. And 6.250% is the interest rate or dividend rate that this stock will pay out. This move effectively amends their main corporate charter, making it official. Now, why all the fuss about preferred stock, especially this particular series? Preferred stock is often seen as a more stable income generating investment. It is less volatile than common stock, and it pays a fixed dividend. Companies issue preferred stock for various reasons. Sometimes it is to raise capital without diluting the ownership of common shareholders too much. Other times, it's to bolster their capital reserves, which is super important for big financial institutions like Citigroup. You see, banks have to hold a certain amount of capital to absorb unexpected losses, and different types of capital count differently. Issuing this kind of preferred stock can help meet those regulatory requirements and strengthen their financial foundation. The filing also mentions a deposit agreement. This is where things get a little more interesting for the average investor. Often, when companies issue preferred stock, especially in smaller denominations, they bundle them into depository shares. So you don't buy a whole share of preferred stock directly. Instead, you buy a depository share, which represents a fraction, like 1/10 or 1,000th, of a preferred share Computershare Inc. And Computershare Trust Company Naya are acting as the depository. This makes it easier and more accessible for more people to invest in this new preferred stock. They are essentially acting as middlemen, handling the shares and issuing receipts to investors. And to get these depository shares out into the market to raise an underwriting agreement. This agreement, signed a bit earlier in January, lays out the deal between Citigroup and the investment banks known as underwriters. These underwriters essentially buy the shares from Citigroup and then resell them to the public. It is how big companies make sure their new securities find buyers. This confirms that Citigroup is actively looking to raise money through this new preferred stock offering. Looking at their registered securities, it's clear Citigroup has a complex web of financial instruments out there. This new preferred stock is just another thread being added to that intricate tapestry. It shows they are constantly managing their capital structure, a crucial task for any global financial giant. They have common stock, various series of preferred stock for different needs and maturities, and likely many other forms of debt. Lastly, you'll see an opinion from a law firm, Skadden, Arp, Slate, Mega, and Flom LLP. This is standard procedure. They're providing a legal opinion to confirm that everything related to this new stock issuance is on the up and up, legally speaking. It's like getting a seal of approval from the legal experts. Now, what does this all mean for Citigroup and for us watching? Well, this move signals a proactive approach to capital management. By issuing this new preferred stock, Citigroup is likely aiming to strengthen its financial buffers, maintain strong credit ratings, and perhaps fund future growth initiatives or even unexpected market demands. The 6.250% rate is a clear signal of the cost of this capital. It is a fixed, predictable expense, which is attractive in uncertain economic times. This also suggests that while they need capital, they might not want to take on more traditional debt that could add to their interest expenses, especially if interest rates were to fluctuate. They are essentially diversifying their funding sources and managing their risk profile. It shows a company that is not just reacting to market conditions, but is strategically planning its financial future. It also tells us that they are confident in their ability to generate enough earnings to cover not just their operational costs, but also these dividend payments. What's notable here is the creation of a new series of preferred stock. This isn't a common occurrence unless there is a specific strategic need. Given that Citigroup is a massive financial institution, it's likely tied to regulatory capital requirements or a specific funding strategy. The fixed dividend rate also suggests they are prioritizing stability in their funding costs over the potential for lower rates if market conditions were to improve significantly. It points to a management team that values predictability in their financial obligations. One potential risk to consider is the cumulative nature of dividends. While this issue is non-cumulative, meaning missed payments don't accrue, a consistent need to issue preferred stock could signal underlying pressures on their profitability or capital ratios. However, in this specific filing, the focus is on the establishment of the stock, not its immediate performance. So, to sum it up, Citigroup is issuing new preferred stock to bring in more capital. This is a calculated step by a major financial player to solidify its financial position. It is a sign of thoughtful financial strategy in a complex global banking environment. Alright, that is our breakdown of Citigroup's latest filing. What's your take on this preferred stock issuance and what it signals for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.